Hello and welcome to the lecture for Chapter 3. This chapter we're going to really talk about adjustments, and adjustments really come down to one of the major differences between bookkeeping and accounting. So bookkeeping is recording transactions as they occur, the light bill, paying payroll, receiving checks from customers, those kinds of things. Accounting involves that plus making adjustments to get the story that we tell about what occurred in the business correct. So we'll talk a little bit about that in this chapter. So some new principles in this chapter that we haven't talked about in the first two chapters is one, the time period assumption. So if you wanted to absolutely accurately tell the story of what happened in a business, you would look at the condition of the company on day one, and you would look at the condition of the company on its last day in business, and you would say, this is how they did, right? That would be the perfect way to describe what occurred in a business. The problem with that is that most people don't want to wait till their last day that they're in business to determine how they did. That means that we need to break the life of the business into artificial time periods. Those are called fiscal years, quarters, months, etc. The need to break the life of the business down into time periods like that then gives rise to the problem as to when do we recognize revenue, when do we recognize expenses, which period do they fall in, and how much to recognize. If I pay my bill for insurance on my vehicles for the upcoming year, do I recognize the expense on the day I write the check? Do I recognize it on the last day of the insurance period? When do I recognize it, and how much do I recognize each month? For that reason, we'll look at both revenue recognition, so when do I kind of get credit for the work I've done for customers, and expense recognition. Expense recognition, the key thing there, and I have the word in red, is matching the expenses to the relevant revenues that they're associated with. That's the key thing. So there are two different basic methods of accounting. Very small businesses can use cash-based accounting. Say you're doing yard work for people as a side business during the summer. You could use cash-based accounting. What that says is we are going to recognize revenue when we get money, not necessarily when we do the work, but when we get paid, and we're going to recognize expenses when we pay them. So it's all cash driven. Very small businesses can do that, but in order to be compliant with generally accepted accounting principles, or GAAP, we have to do accrual accounting. And the difference between accrual accounting and cash-based accounting is with accrual accounting, we're going to recognize revenue when we provide goods and services to a customer. And we're going to record expenses in the same period as the revenues to which they relate, regardless of when those things happen, when the payments happen. So here's an income statement from the textbook, and I just wanted to talk a little bit about that. So this is for a restaurant. It's a little bit odd. I would have expected there to be cost of goods sold and gross profit here. What are the cost of the meals and preparing the meals for customers? So I'm a little bit surprised at the format here. But in any event, you see revenue. Again, that is sales revenue based on what they provided to customers, not necessarily when they were paid. And then there are some operating expenses and general administrative expenses, depreciation. Notice we have loss on disposal of assets, so we have total operating expenses, and that gives us income from operations. So that's how much did the core purpose for which this business exists, how did that do? And then we have other items. In this case, we have interest revenue and interest expense. Those are items that don't really necessarily relate to the core purpose of being Chipotle Mexican Grill Inc. So we keep those separate. They still affect the bottom line, but we don't include them in kind of the above operations line. Then we have income tax expense and net income, and then they report earnings per share. So that's taking the net income of the business and dividing it by the number of common shares outstanding. It's an important figure because people will look at that relative to the price of the stock to kind of determine, is it overvalued, undervalued, or kind of how speculative is the stock price. So I want to talk about adjustments in two categories. The first category is about cash. When is cash received? So cash could either be received before we give the product to a customer. Somebody pays us in advance for work we're going to do. It could occur at the moment the food is delivered, or in this case, food is delivered, or when we provide the product and service to the customer. It could happen right that moment, or it could happen later. So under those three circumstances, we would account for that cash in different ways. So if cash is received before we give products to customers, say I'm going to do a consulting project for you and it's going to take 3 months, and I tell you I'd like my $9,000 for this engagement up front. Well, when you pay me that $9,000, I'm going to debit cash because I'm putting money in the bank. I need to increase my cash account, and I'm going to credit a liability called unearned revenue. And it takes students a lot of time to kind of get their head around, why does that create a liability? Well, the reason it creates a liability is that if for whatever reason I can't do that consulting work for you, I need to bow out, or you decide to cancel the contract, or whatever the case is, if that's not going to happen, I owe you that $9,000 back. So at that moment, I have a liability. Now, as I earn the revenue, I'll convert that liability to revenue. So each month I do work for you, I'll reduce it by 1/3. So at the end of the project, when I've completed it, I will have recognized all the revenue and I will not have a liability anymore. If cash is received at the moment of delivery, that's really simple. Debit cash, credit revenue. If delivery is made before cash is received, then that will create an accounts receivable. An accounts receivable is money that is owed to me from customers for services I've provided or product I've provided. So in that case, when I provide the service, I would debit accounts receivable and I would credit the revenue account. When I receive the cash later, I'll debit cash and I'll credit accounts receivable. So to look at some of these entries, so first, unearned revenues. So when we receive the cash, like I mentioned, I'll debit cash and I'll credit some kind of unearned revenue. In this case, it's unearned rent. So I'm a landlord and I'm renting something out. So I receive the cash that somebody pays me in advance for the rental period. At that moment, I haven't earned anything. They haven't occupied the space that I'm renting to them yet. So that's one way to look at that. And you can see below it would be more like a consulting arrangement kind of a thing. So that's the initial transaction, how we would record it. And then either over time or as I earn the revenue, so if it's rent, it's as they've occupied the space, I'm going to reduce that liability by debiting it. I increase liabilities with a credit, decrease them with a debit. So I decrease that liability and I increase my revenue. I recognize the revenue at that time. In the case of fees, same kind of a thing. I would decrease the liability and I would recognize that I've now earned, or I get credit for some of that revenue. If it's at the time of delivery, as I mentioned, that's very straightforward. I debit cash, I credit revenue, we're done. Then again, if I get the payment afterwards, I will debit accounts receivable and credit revenue, and then later I'll receive that account, or I'll receive the cash. So notice it says to record services provided on account. Remember, whenever you see the words on account, it means that payment is going to happen later. I could provide services on account, which means I'll get paid later, or I could buy supplies or services from my suppliers on account, which means I'll have to pay it later. That's the distinction there. So the other type of adjustments deal with cash that's paid out and the timing of that. So I could pay for cash in advance. So I could purchase some repair contract before it's being used in this case. I could pay for it at the moment that I get the service or get the product from a supplier, or I could pay for it later. If we pay cash before we incur an expense, that's going to create an asset called prepaid expenses. can imagine if you were going to buy my business from me and I told you that I had paid the next year's rent in advance. That's not something, you don't need to worry about paying rent because it's already been paid. That's a value to you as somebody that is buying my business. That's an asset in my business that you're acquiring. Okay, so I'll record that as a prepaid expense, which would be a current asset. If we pay cash at the time of the expense, then it's very straightforward. Recognize the expense, decrease cash. If we receive the service or the goods from somebody and we're going to pay for it later, that's going to create a liability called accounts payable. So accounts payable is the amounts that we owe our suppliers for goods and services that they've given us. It could be for our utilities, for our cell phone, for consulting, for legal services, for cleaning supplies, you name it. So to look at those examples, so prepaid expense, the advance payment of a future expense. So here's a case where I have paid my insurance in advance. So the initial transaction is I debit the asset, the current asset, prepaid insurance, and I decrease cash with a liability. That's something that would then change over time, right? It would become an expense as time elapses. The other way to do it is to record the asset if it's a physical asset. In this case, it may be supplies that are going to be consumed over the course of the next year, also a current asset. And I would increase that asset with a debit, and I would decrease the asset cash with a credit. So either over time as insurance expense, as I use up my insurance with time passing, I'm going to record that expense each month and I'm going to decrease the asset each month. So in this case, I paid $2,400 for my year's insurance. So each month I'm going to record a 1/12 of that. So I'll record an adjusting entry to record the expense, 1/12 of what I paid for the year, and I'll decrease that prepaid insurance asset. In this way, at the end of the year, the last time I make this entry, that prepaid insurance account will go to zero, as it should. In another case, with supplies, that's not really based on time elapsing, it's based on actually consuming the supplies. So I would look at how much supplies I had on hand to be able to back into what was used, and I would record the associated expense during that month, and I would reduce the asset that I had. So sometimes expenses are paid immediately upon receiving the bill. So in this case here, cell phone expense is for the month. I debit the expense, I credit cash, very simple. A delayed payment is going to create a payable, as I mentioned earlier. So I would record the expense in the period in which it was incurred, I'd record the liability, and then when I pay it later, of course, I would be debiting that liability and crediting cash. So one last topic I want to talk about that could be complicated in some businesses is revenue recognition. In most cases that we've looked at in your accounting education up to this point, it's been fairly straightforward. I'm going to do consulting for you. It's going to take 3 months. Here's how we account for that. I'm going to spread it over the 3 months. In other cases, I'm going to sell you a picnic table. Here's the picnic table. I recognize revenue because I've just given you the product. That's all pretty straightforward. What if I sell you a car and I also include 3 years of free roadside assistance and I include an extended 10-year warranty, 10-year 100,000-mile warranty that's in addition? So that when I sell you that car, I'm really selling you a bundle of things. I'm selling you the physical car that you can drive off in. I'm also selling you separately in a way, although I'm bundling it together, that roadside maintenance benefit, and I'm selling you the extended maintenance. So in that case, I would want to identify the contract between the company and the customer. What does that contract consist of? Is it simple, here's your product, or is it a bundle of things? If it's a bundle of things, I'm going to identify what my performance obligations are as the supplier. So what do I need to do? I need to give you a car. I need to be available and give you roadside assistance. I need to fix your car when things go wrong for 10 years. Then I'll look at the total transaction price. What did the customer pay for all of that? And I'm going to break that transaction price into the performance obligations. So how much is roadside assistance for 3 years worth? If somebody came in separately and just wanted a contract with me for that service, what would I charge them? If somebody wanted to buy a 10-year warranty on a car, what is that worth to the customer? So I would take that total price I charged and I would break it into those 3 components. And then I would recognize that revenue for each of those components as it occurred, as I've satisfied the obligation. So you drive off with the car, that's when I'll recognize that portion of that revenue. The roadside assistance that I've offered you, I'll recognize that on a straight line basis over that 3-year period. The amount for the maintenance contract that I offered you, I'll recognize that on a straight line basis over the 10 years. So that one sale will result in different types of revenue recognition given the complexity of the transaction. So hopefully that makes sense. Please work through the in-class practice problems and look at the solutions, and then tackle the homework problems for this chapter. As always, if you have any questions, please don't hesitate to shoot me an email. Thank you.